So this is a recording of a fireside chat we did with Adrian Di Marco. Adrian's the founder of Tech One, or Technology One, that's listed on the ASX. I think the market cap recently reached about 10 billion. So it's a ASX top 150 company. We go deep into his philosophies on early stage investing, how he approaches investing in funds. And we coincided this session with the launch of Tribe's Nexus Fund.
It's always a pleasure having these conversations with Adrian. He's been a supporter of Tribe since the very beginning, one of our founding shareholders, also one of our venture partners. He's been an active investor through our syndicate. And now it's fantastic to have Adrian also on board as a cornerstone in our Tribe Nexus Fund as well. Tribe Nexus Fund is a $30 million ESVCLP fund targeting B2B tech ventures from Australia as they scale into the UK and US markets, and really taking advantage of the valuation arbitrage that comes from that international expansion into those markets. The fund is an ESVCLP structure, which means there's tax advantages for Australian residents with a minimum investment of $250,000, which is called over a 3-year period. In this content, you'll hear how Adrian approaches investments, and it's really interesting to hear his perspective on emerging fund managers. And you'll hear him explain why he's backing Tribe as an emerging fund manager, but also particularly at the stage that we invest in as well.
Well, we'll get into the session and we'd welcome any feedback. Adrian, really appreciate you joining us. Just to give some context, what do you think some of the biggest lessons you've taken from your Tech One journey into what you do in early stage, whether it's early stage investing or funds, that transitionary point of leaving the CEO role and deciding to invest? What are some of the things you've taken?
Oh, that's an interesting question. There's a lot of things I think you take away from that journey of building a company, and it started from very small to becoming very large. And I've taken that into this new stage of my life as an investor and having a family office. So a couple of things. First thing, keeping it simple is really critical. That was one of the things that really drove us when building Technology One. We wanted to keep it simple, and it was always the front of mind. How do we simplify the experience for our staff, for our customers, for everything we do? It was about simplifying it. And if we didn't know how to simplify something, then we didn't understand it. If we didn't understand it, then we shouldn't do it. So I've taken that across into this new stage of life. It's about keeping it simple. If you understand something, fine. If you don't, then you shouldn't invest, you shouldn't do it. So that's a guiding light for me still. Strategy is also very important. You need to have the strategy right. I talk a lot about Tech One's lost years. So there was about 5 years which we lost in our journey. And that was because we didn't really have a clear-cut strategy. Once we got the strategy clear, absolutely clear and simple, because I come back to that simplicity concept, really simple, we then were able to scale the business really, really quickly. But until the strategy was right, we lost, I'd say, 5, maybe more years, and it was a very frustrating period. So again, bringing that into the family office, having a really clear-cut strategy of what we're doing and keeping it simple, they are the things that really I take out of that. There are a lot of other things I can touch on, but they're probably the two big things. And I'm not talking about complicated strategies, I want to say too. When people talk about strategies, they're talking about these big documents and lots of written stuff. A strategy is no more than a piece of paper. That's all it is, one piece of paper. If it's more than that, it's too complicated. You can't communicate it, you can't live with it, you can't enunciate it. It's got to be that simple, the strategy. So
if we look at that strategy, when the people that we engage with from an investor point of view, we find that there's a group of people that have no allocation to private markets, and then there's sometimes a group that have an allocation, but it's not very strategic. It's all over the place. If we were to start at that really high level, you in your family office has obviously taken a view that private markets are important to have as a portfolio allocation. How do you view private markets? Generally, there's obviously illiquidity and all of those things that you've got to deal with. Why do you even entertain having an allocation to private assets? And then we can unpack a little bit into the different buckets.
No, it's good. Another good question. Let's start with the first part, which is the public markets. Let me say, public markets are highly efficient, very transparent, and they perform exceptionally well. And so we are heavily invested in the public markets. We will probably have an allocation somewhere in the order of 70% into the public market and public markets. So strong believer that there's a lot of runway there, and it's such a great place to invest. There are problems and issues, but that's another topic. But then you've got the private space where we would allocate probably around about 30%. And in that, we divide that between alternative investments, which are not correlated to the public market. So we like things that are not correlated. So if the markets in the public world are crashing, these investments will stay pretty much where they are. They're not have that high correlation. But particularly we like the VC space. We think that the venture capital space is where there's opportunity to really get outperformance and significantly improve your returns. In the public market space, we're happy to basically follow the index. It's really hard to beat the index. All the research shows that getting outperformance is difficult in public markets. If you can pick a particular area that's underperforming, like we invested significantly into China about 3 years ago, we thought it was terribly undervalued, still is. We think it's just a fabulous area to invest. Then you can make outsized returns there. But generally speaking, public markets are hard to do those outsized returns. In the VC space in particular, you can get those really significant outsized returns, but you've got to know how to play it.
When you then look at the VC space, there's do it yourself, there's back a fund, you've got a bit in both. How do you look at that if you were to double click on the allocation, the work that you do yourself finding companies versus the funds that you back?
Yes, it is very different reasons why we have done that. Investing in a fund is a lot simpler, there's no doubt about that. The big decision you have to make is this the right fund and the right fund manager? Because they are all very, very different, have very different styles and return profiles. But it is very much set and forget. You make the decision who you're going to give the money to, and they run with it. And we've done a little bit of that. That was more in the early days as we wanted to understand the ecosystem. We wanted to build relationships, and we found that was a good way to do that. We then moved from that, having done that, to being very active ourselves. So investing directly, taking a seat at the table, working with founders, and really driving that performance. That's an area that I have a lot of expertise in, having built a business. I think as I get older and the family office goes to the next level, I don't think my children have that appetite, and so I would think they would move more back towards the funds approach. But where we are now, we're very active in that VC space and do it directly, and we see it's a good way to get those outsized returns.
In the game that we're in, without wanting to be oversimplistic, we've got to find deals, we've got to choose deals, we've then got to win the deal, which a good deal is half won. We've got to support the thing, and then we've got to get it exited. Like that's the value step. What we find is that some investors that want to get private market allocation, that they then don't have the networks to get the deal flow. Would it be fair to say that your brand and reputation and just being an operator has brought you a lot of deal flow that is hard to replicate? And how would you advise people if you really want to get to the picking your own deals? How do you approach that deal flow aspect?
Yeah, I think that can be really tough. And I'm very fortunate because having built Technology One, I've been able to create, let's say, that awareness that I'm in the marketplace, and I've built a network through that, and I get a lot of approaches through that ecosystem. Also, too, having built relationships with VC organisations, quite often they will introduce me into a deal because specifically it might be my area of expertise, and vice versa. Through that network, I'll introduce them into deals as well. So there's all of that comes into play. I'd also say too that we're very selective. We're not after a huge amount of deal flow. As a private company, a family office, we don't report to anyone. So we don't really care if, for example, it's quiet and there's no deals that we like for 3 to 6 months. We'd rather not invest than invest in something we don't really believe in. So we're very picky, very choosy. We can take our time. And when the deal flow is there, wonderful. If it's a bit slower, that's fine as well. And then we also find the founders will bring us deals from other founders as well. So it's interesting, that whole ecosystem. the way it works.
What makes a good founder? You deal with a lot of them, as we do. What are some of the attributes that you're looking at from a point of view of being backable and investable?
Yeah, the founder is number 2 on the list. If we look at when we invest, we look at the strategy first, and then we look at the founder, and then we look at execution, number 3. So the founder's the second on the list, not the first, because if the strategy isn't right, then you're backing the wrong horse. It's quite hard to change the strategy. But the founder is second. And having learned the hard way in my personal experience and before Tech One, even during the Tech One days, and then subsequently in some of the investments I made, the founder, you really have to believe that they're an open, transparent, decent kind of person, because no point trying to build a business with someone who isn't like that. I have been there before and had to walk away because that person wasn't the right person. So you have to have that belief that they're open, they're transparent. Everyone gilds the lily a little bit. That's what a founder does. They're not dishonest, and they'll be true to their word and do what they say they're going to do. So to me, that is very important. Also too, founders come in 2 shapes, basically, I found over the years. Those that are, I would call, management type founders, and those that are more leader type founders. And to build a business in the early stages, you need to be more of that leadership type, not a manager style. It is a very different persona, a leader to a manager. And so I always run that lens against the guy. If he's a manager type, then he plans, he schedules, he's good on all the hygiene sort of stuff. That's not going to build a company, not in the early days. You need a leader type, and a leader is the opposite. They're not great on the planning, the scheduling, but they're very big on the vision, and they're very good on motivating and reacting and changing and adapting and making what needs to happen. It's a very different persona, that leadership persona, as distinct to a management persona.
So then when you're looking at the strategy, what are the key attributes of what you believe is a good strategy?
Well, simple. First, I come back to it. I always ask them to tell me what your strategy is. And if they take 5 minutes to do that and they and ah and they waffle all over the place, then that's a bad sign. I used to have a 1-minute rule at Tech One. If someone had an idea, a vision, and you probably wanted to build, I say, well, there's a whiteboard, you've got a minute. If you can't convince me in a minute, then go away and don't waste my time. And they might come back 10 times and finally they would be able to do that. And so I have that same expectation when I talk to founders. I want them to be able to clearly enunciate that strategy. That to me is the key thing. And what I look for is, again, simplicity in the strategy. You can make it really complicated or you can make it simple. I really believe that building something that is very focused for a well-defined customer and something that is narrow but deep is a much simpler strategy to execute. The opposite to that is to build something for everyone and to build something that is very broad, okay? And that is really difficult to do. Now, if you do it, then you're going to make a ton of money because you're building almost an operating platform. And that's what Tech One was. We built this huge ERP system. But God, it was a hard strategy to execute, really. And so I like it when it's very narrow, very deep, a well-defined customer. And that's one of the first questions I ask. I say, who is your customer? And if they say to me, I'll give you an example. Recently, someone said to me, oh, our customer is education. And I said, what does that mean? And they said, oh, well, we're going to sell, and we are selling to high schools, and we're selling to universities, and we're selling to TAFE colleges. Well, I didn't like that. And I said to him, why don't you narrow it down? Oh, no, we're going to sell to everyone. That's really hard to do because they are fundamentally different businesses. They just happen to be similar, but they're different. And it's in that difference where it becomes really difficult to execute. And that's where you get very confused because you're trying to build something for 3 different personas and you don't know which one you should be building for. When if you have a well-defined customer, so let's say your customer is universities, well then, okay, that's really much easier. You just go and do what the universities want. And if you narrow it down even further, I want to deal with big universities as distinct to small universities, that's even better again. And if you can build something for that particular customer, and you can really get the nuances right, and you can really build deep and do everything they want and rise to the occasion. So they're going to challenge you, right? They're really going to be demanding and difficult. If you can rise to that occasion, then you will build a great piece of technology and a product, and they will pay for it. And you can then take that globally. And I think focused, narrow, deep, and global is the key, because then you can take it all over the world. And obviously products or ideas where the regulatory burden is not huge. Like if every time you want to go into a new country, you're going to have to do a lot of work to make it fit into the regulation, that's a huge impasse. So again, things that there's not a huge regulatory overhead to take it globally. So that's the sort of thing I look for in the strategy.
So you like the strategy, you like the founder, and you do the deal. Now you support them because you're quite hands-on. What is your approach to supporting deals? How does it work, and where do you sit in terms of the level of support you need to provide them?
Yeah, it's a journey. So when we first get involved, we'll be a lot more active, but then as the years go by, the activity reduces, because it should reduce, because they get through that critical stage and you've helped them build that network around them, which is the exec team, a board, they've got governance, the strategy's right. And so really you want to get to the point over a number of years where pretty much you see them once a year, and that's it. That's the goal, and they're running and running hard. And once they get to that point, that's very exciting, because you see these guys that are really scaling, growing fast, and they're doing it themselves, and you're got a significant chunk in the business. So it's a wonderful position to be in. So the goal is always to make yourself obsolete. But in those early days, it's working with them, but not actually doing the job for them. I think there's a line that you can take a horse to water, but you can't make it drink. And I think that I learned that pretty early on the journey, that actually getting in and trying to do the job for them is a step too far. You can give them the idea, you can point them in the right direction, and then it's up to them to make it happen. And the good founders are the ones that get the idea, they will challenge it, they'll maybe talk to other people, coalesce on that idea being right, but then they can execute. And we don't get involved in the execution, but we say if they can't execute, then what are we doing here, wasting our time? And we'll actually disengage with the founder if we find they can't execute. So if we have a conversation with them, we agree that this is a good idea, they agree with it's a good idea, and we then leave them to execute. And if after 3, 4, 5, 6 months we don't see the traction, then we start saying, well, maybe we've got the wrong founder here, and we'll give it a bit longer, but we'll then disengage after that time, because you can't make someone do something, and you can't do it. You can't do it for them.
A question was asked by one of the audience as to when Adrian thought it was the right time to move the founder out of the CEO role. Has that ever occurred, and what was his thoughts on it?
Again, it depends on the founder. If the founder can grow with the business and they're nurtured and encouraged in how to do it, then why change course? And quite often it's because the founders have limitations on themselves. They get to a point and they lose a bit of confidence in themselves. And I think that's the point where you then have to look at, well, some founders don't have the ability to change, so that's fine. Some founders just lose confidence. And then you've got a small group that still retain confidence, and they're coachable and they learn and they can make that transition and continue to grow with the business. And that's the ideal situation. Founders like that, but that's not always the case. So it just depends on the particular circumstances and stuff. It's good if a founder can't make that transition and they learn to recognize that, and you can help them recognize they step aside. But some founders won't do that, and they then take the business down with them as well. And that's, again, one of the challenges.
Thank you for the question. I should have said at the beginning, please get your questions ready, either as soon as they pop in. Yeah, Sam.
Another question was asked about Adrian's allocation of 70% public markets and 30% private. And the question was asked, given a lot of companies are staying private for longer and a lot of returns are being held in the private structure, does he see that allocation changing over time?
Yeah, I'm not sure we would do that. I think the problem is people are staying private for longer. There's a lot of overhead being public, and there's a lot of crap you've got to deal with. So that's the problem. But I think that the problem with companies staying private for longer is that they're big, but you really don't know the accounts and the books, how accurate they are. Pick any big company that hasn't gone public yet. How do you really know how they're performing, really, seriously? I mean, if they're not audited, then you don't really know, and there's not the same scrutiny. The thing with public companies is there's a huge amount of scrutiny. That's the beauty about it. There's so many people point over the audited accounts and talking to the CEO, and there's just so many points of references. So I think the problem is that staying private for longer does cause problems for investors, not just for liquidity, but they don't really know what's happening. You get the blurb from them, but it's not the same. And it's hard to make the returns as well for being private when you invest in companies in those rounds. When a company is $1 billion or $10 billion and you're investing in that round, the law of numbers starts to work against you. To go from 1 billion to 2 billion is hard, and to go from 2 to 10 is hard. You know, where to go from 50 million to 100, we'll say 20 million, which is Series A raise, to go from 20 million to 200, well, numbers work for you there. That's not that hard to do, to go from 20 million to 200. So you can get a really good return in those pre-Series A, Series A type deals. It's really hard in those bigger valuations to get that. And that doesn't mean you can't. Canva's showing that $1 billion valuation, and then it's 10 billion, then it's 20, and now it's last thing I saw, last raise they just did was 35 billion. We got approached to participate in that, and we just said, well, it's private, but it's public market type returns is what I said. Maybe they'll prove me wrong. Maybe they'll go from 35 to 70 billion. I don't know. But it's harder to do.
I guess related to that, how much effort do you personally put in on the exit side of your portfolio? Are you proactively looking for things, or that just sorts itself out naturally?
No, those things never sort themselves out naturally. So it's all about the exit. But that's why we like to get in and be part of a system where there's a VC in it, because the VCs are really good and focused on the exit strategy. So that's their strength. We see that they will encourage the exit, and they will create the conditions for that to happen, and create the opportunity and bring the credibility as well. So that's why we like to partner with VCs and have them on the table as well, so they can focus on that. There's a lot of work to make an exit happening. It's a very specialised skill, so we leave that to them. Yeah, and we said we're relaxed. We don't mind if the exit happens in 6 years or 8 or 10 years, as long as the company is growing, and at some point there's an exit, then we're happy. And we're quite happy quite often to encourage the founder not to exit too soon, to actually be the devil's advocate and say, why don't you just let it run a bit longer? So
yeah, I think when you look at venture math of a company that's growing strongly, it can often be 30 to 50% of your returns are actually in the last 18 months to 2 years. And to the issue about companies staying private longer, one of the drivers there is the secondary market has absolutely bloomed, but you see so often people taking a secondary too soon, leaving a huge amount of money on the table.
Yeah.
At the time, it felt like a win, but if you hold on too long, that can be a problem as well.
Yeah, I'd rather hold on though to the end. I think sometimes it might blow up, but I think if you stay to the end, you're really going to get the supersized returns, because that's what does happen. They start to scale, they're getting that critical momentum, they're executing well, and they just keep doing it and doing it and doing it. I mean, you just see the numbers keep going positive. So we like to stay in. We had a chance to exit a couple of times, and we said no, and sometimes we've been asked if we could be part of the roll-up into a bigger company and get a percentage of that, and our experience has always been better having done that, really, rather than taking the money and walking away too quickly. So
your private market allocation is for money that you don't need tomorrow. Your 70% is the liquidity thing, that if you change strategy or you wanted liquidity, but you're effectively being paid an illiquidity premium for hanging on for that period of time. And therefore, from a portfolio allocation point of view, it's making sure you get that balance right.
Definitely. That's a good way to put it. And I think in the VC area, that liquidity premium can be substantial, where in a lot of other areas, you're locking money up for 10 years and the returns are not, they don't justify it. Like, to lock your money up for 10 years, the world can change so dramatically. You need to get the sort of returns you get out of venture capital, and you can't out of a lot of other things. That's been our experience.
I'm sure there's not a huge list of people that get approached for the Canva type raises. So you're obviously on the call sheet of the big ones and the little ones. So how do you sort of look at big VCs, little VCs, medium VCs? How do you see that market and evaluate them?
I think if you're going to invest in the VC funds, I think there's a lot of research that shows that you're better off to invest with the smaller fund managers rather than the bigger ones. I think history has shown that generally speaking, they return better returns while they're small. As they get bigger, they have a lot more money to deploy, and so they've got to write bigger checks, and so they can't get into the smaller val deals, companies that are valued around that 10 to 20 mil. And I think that's a real sweet spot. If you can get into companies at that $10 to $20 million valuation that have got good ARR, they've got good metrics, so you can see the traction, you can get, I think, really outsized returns. And that's the problem. When you're writing bigger checks, you've got to go then with the bigger valuations. And also too, I think it's hard to scale that whole VC stuff. It really is. I've seen VC fund managers that started small and were fabulous, but then as they grew and grew and grew and added more and more people, there was a dilution that happened. And I don't think anyone's really solved that issue. So normally the founders really understood the market, the niche, had the expertise, the knowledge, and then as they added more and more people, that got diluted. So I think, again, it plays more to the smaller, I think, VC fund managers than the bigger ones. So that's my take on it, yeah.
So an audience member asked about Adrian doing direct investments into early stage companies and needing to find them and support them versus just investing in a fund, how he thought about that, how he approached it, and was one better than the other.
When we look at being very selective on the companies and actually actively engaging with them in the right way at the right time, where we can add substantial value. So, but as I said, with my kids becoming more active in the family office, there's definitely a leaning away from that. They don't want to do that. They have no interest in doing that. And so I would expect that as I start to reduce what I'm doing, they want to move a lot more towards VC fund managers. They don't want to deal with all the hassles and problems that go with it, because it is work. You've got a company you're working with and things have gone pear-shaped and blowing up, and you're taking calls in the middle of a holiday and you're doing Zoom meetings and that sort of stuff. You've been there. And so it's a disruption in your life. So yeah.
I think it'd be fair to say that there's a personality point to it. I absolutely love venture, as does Aaron, and interacting with you and the support you've given us. There are some difficult times, but I think we do it because either we're stupid or we actually enjoy mucking in with the founders. When you are the first call of a founder and they've got a problem and you're working through it, you're happy to give your holidays up. You've got to really love it.
I mean, you've got to love it. That's the key thing. I have friends and they love playing golf and doing all this sort of stuff. I really enjoy working with the founders. To me, it's really a lot of fun. I enjoy that. And then seeing them taking the ideas and running with them and the traction. And then the nice thing is you're making a lot of money along the way, but you've got to enjoy it and you've got to be prepared to put the time in when it's required. And you've got to be prepared to make the first few mistakes too that cost you a fair bit of money. And then you've got to build up the experience, but also everything to support it. Like you've got to look through the legal documents. You've got to be able to negotiate something that works for the founder as well as yourself. There's a lot in it. Like you just can't do it as a hobby. You've got to really enjoy it and put the time in. So, and then you've got to have the people behind you to support you. You've got to have the legal people that really can take care of your interests and negotiate and help you negotiate something that's fair to the founder and fair to yourself and give you the protections you need. So, and there's a thin line because you can be really heavy-handed, which is not good for the relationship. And we see that with VCs. To be honest, some VCs are very heavy-handed in the sort of contracts they want. And then you can be the other way, where you can be naive and put yourself and expose yourself unnecessarily. So finding that middle ground. So there's a lot involved in doing it. So it's not for the faint-hearted, I don't think.
So you were CEO of Tech One. You then stepped aside from this CEO role. Then you finally stepped down. Would it be fair to say you ramped up your early stage direct stuff when you stepped down as CEO and that time was reallocated, or were you doing it whilst you were still in the chair?
I got engaged in a particular deal and I loved it and enjoyed the experience and started to spend more and more time into it. And yeah, but it would have happened probably around that time as I was looking at stepping down as CEO and I was continuing as the executive chair. So probably around that time period. And I suddenly realized like there is this whole ecosystem out there of startups and They're doing wonderful things and exciting things, and it was really a lot of fun. Yeah.
So if you think back to that time, what would you do differently? You've got a portfolio, you got your allocation. If you knew everything you knew now back then, what would be the ideal things that you would change, if any?
I don't know, it's hard to answer, because I think that's all comes into getting to where you are, all the mistakes you make, the lessons you learn, the scars that you get. I don't know if you can just jump over that and not do that. So, but as I said, to me now it's a lot simpler, because we look at the strategy, we look at the founder, and we look at execution as the third piece, and that simplifies everything quite dramatically. A lot of things get filtered out very quickly because of that simplistic approach. So we've got a good framework, a good way of how we work with the founders. We've got good artifacts that we can support them with. And it's always the same, to be honest. Like, we've learned the big issue with the companies we've invested in has always been the same. They normally got good R&D, they've got a reasonable product. It's sales and marketing. And we always know that's the place you got to get in and help them with, is getting that sales and marketing, get the product out and get people using it and get the money in the door.
A question was asked whether Adrian likes companies that have many ideal client profiles or a smaller number of ideal client profiles. And does he like them targeting many markets or only a small number?
No, one. I always say just stay with one, but go global, rather than do something here in Australia and then extend out of that into other areas. Even though they're 90% the same, it's that 10% difference where you add the complexity and where your business becomes more complex. But also too, intellectual capacity is what limits you. So if you're dividing your intellectual capacity across a number of different customers, even though they are similar, that is a dilution, right? And how do you prioritize the conflict that you get? So we believe narrow, deep, and don't move out, go global and own that marketplace globally. But it's interesting because you do have the founders that say, but this is so easy. This is just over here. We can go and do it. And what I will say to them sometimes is, well, why don't you try it, but don't make it strategic. Do it as a tactical thing. So don't go and divert all this R&D into this little other area here, which you think is just a simple add-on, a simple extension. Do it as a trial, chase a few deals and just see how it goes for you. And without doubt, they'll get the first few deals and then they'll start having the chickens come home to roost, and they find that they want more than what they had led to believe. There's more product modifications, enhancement, and there's slightly different positioning, and like suddenly the complexity starts to grow, and hopefully then they haven't gone too far and they've got to then backtrack and undo all the mess. We've had the case, there's one deal in particular that they were going to be all things to all people. And well, don't you? And after 3 or 4 years, it's dawned on them that they need to just focus on one thing. But
and magically growth accelerates.
Yes. It's wonderful when that penny drops, but sometimes it takes a while. Yeah.
A question was asked about the current value in the market of the multiples that people are investing at, comparing it to 2021. Does he see now as a good time to invest, and how he's looking at current valuations?
I think where the market is today, there's great value there because the valuations have come back tremendously. Now, sure, those valuations were probably far too high, but it's come back a lot, and people are a lot more realistic about what they can get. So I think it is a good time to invest in the venture capital space from a timing point of view. And I think there's just so much innovation and creativity. There's still a lot of things to be solved, a lot of things to be done. So yeah, and I think if you particularly come back to it, you can do that pre-Series A, Series A. I think it's a great value point. The metrics are there. You're getting in at a good number. You can get a good position in a company without a lot of money, and the rule of numbers works in your favour. To go from 20 million, 30 million to 300 million is not that hard. Going from 300 million to 3 billion, well, that's hard. That's a whole different thing. So I think it's a good time.
We were talking before we started. We've just closed a deal, 4.7 times ARR, growing at 80% last year from a 6 mil ARR base that's just launched in the UK, already at $1 million, and launching in the US. And you can see a path to where that company becomes a 20, 30 mil ARR company, and you've got in it 4 and a bit times. And part of our thesis is we like to be the last money in before we go to the US or the UK. So we can get an arbitrage just in the valuation by itself. But 3 years ago, when you get into a company where you've paid 15 or 20 times, you can't actually outgrow that valve. Even if they do really well, you can't get a venture return. And that's why it's important sometimes to back people that are willing to sit on the sidelines and wait.
Definitely.
A question was asked, referring back to Adrian had mentioned earlier on that Tech One had 5 years in the wilderness where it was just struggling strategically. And the question was around what was the change? How did Tech One go from struggling to nearly the $10 billion market cap it is today?
Yeah, it's the things I've talked about, to be honest. That's what I've taken into the private world today. We would sell our product to anyone. You come in the door and you wanted an accounting system, we would sell it to you, you know what I mean? And so we didn't really know who our customer was. So we got into, for example, retail space. And retailers, you would think, wouldn't be that too different from anyone else, but we end up having to do an enormous amount of R&D to handle the uniqueness of retailers. They wanted point of sale suddenly, and then suddenly they wanted batch lot tracking and stuff, and we poured all this R&D into this stuff, and it was a huge distraction. And on the other hand, we had customers in local government, and we had customers in higher ed, and higher ed, they have this requirement, like they have this requirement, and we were just being pulled all over the place because we had a product that on the surface was an accounting system everyone could use, but they wanted it more. They wanted this, they wanted that. And so as soon as we said, no, we're going to start focusing. And so we went to our retailers and said, look, we're out of this market. It was really hard to do because we was done to get a real momentum in retail, but we had to go and say, look, this is not a market for us. We're not going to close shop tomorrow. We'll give you 5 years to transition, but we're not going to be there. That was really, really difficult. But by narrowing down, we were able then to really execute successfully. There's still legacy there. We're still in a number of markets that we're in tactically, but we don't really invest in. The markets we focus in today is local government and higher education. So we have two, and we manage that complexity. In the UK, we're narrowing down further, and when we go to the US, it will just be one of those markets.
And
the whole idea
accounting's
is
become ERP. It's more of an ERP platform now.
Oh, it's an ERP system. That was part of it. We were pushed because of what was happening to become ERP. When SAP and Oracle ended, we had to suddenly go from the accounting system to this ERP system, which was just a huge amount of R&D and development and stuff.
The filter we use internally, whether it's for deals and with portfolio support, is I always ask the founder, do you know Tech One? Generally, yes. You know their market cap is 10 billion. Oh, okay. Do you know how many markets they serve? Universities and local government. And they provide something that is so competitive. Like ERP has competitors coming out the wing. So success leaves clues. And I guess the strategy we've adopted, which I think is why we've aligned quite well, is if it's too complex with all of these different opportunities, it's just statistically, we don't see that play out. We see simplicity win every time.
Definitely. And look, if we'd made the hard decision and narrowed down to just one market, local government or higher ed, we would have been in the US much quicker, much faster, and we would be a $20 billion company today. It has cost us. There's no doubt about that. It comes with a price, that extra level of complexity. And that's why I'm so focused on keep it simple, go global, go deep, stay true to your customer, give them a fabulous experience.
We might move for some drinks. I want to thank you for your time, but I also want to really thank you for your support of Tribe. If I could be so bold, why have you supported Tribe from the beginning?
Yeah, it was really a chance meeting. I think, if I remember right, it was with Mark Salby, and he mentioned you guys, and I had met Aaron before in a previous life, and I knew of you, Don, through my relationship with John McTaggart, and he was the founder of the Brisbane Angels. So I had some sort of idea about you guys, but when I heard that you guys were establishing a VC organisation here in Brisbane, I thought, well, that's fabulous. Like, we need to have VCs based in Brisbane, not people that come into Brisbane and sell their wares and that sort of stuff. Someone who is actually based here. We want to build that ecosystem here in Brisbane, in Queensland. And there's so many great startups here and so many passionate people with great ideas. So to be able to support someone that was doing that, and there are others that are doing it, I just thought this was great. And to get into the ground floor, and then when we talked and met, we were so aligned on the key issues. It's strategy first, it's founders, go deep. The fact you were focused just on SaaS, B2B was also great. And then I think the operational experience and all those things just ticked the box for me. And I thought, no, great, we need to have more here. And people don't realise it makes a huge difference If you've got the head offices here of companies, if you've got the VCs head offices here, the networking that happens is phenomenal, and the ecosystem just grows so much faster. So hopefully this will be the start of a lot more happening here.
Yeah. Well, Tribe runs two models. We do a syndicate model where investors can choose the deals that they like. And then we have the fund option for those that want allocation to the private markets. The beauty of the syndicate being side to the fund is having LPs. And when you put a deal out there, it's amazing what we learn. The due diligence is incredible. The networks that we can pull from is incredible. And so we have those two options, which I think differentiates us in the market. And I think the branding of Tribe is really what we're trying to create. For those that are involved in our deals, the connection to the founders, being able to help when they want to, and your expertise assisting the portfolio companies is absolutely, just tremendous. So if there are no other questions, what we'll do is we'll close up for some networking. Can we give Adrian a big round of applause?